Welcome back to the show. Well, the stock in focus right now is Dabur. The stock is trading higher because despite the macro environment slowing down, Dabur has managed to see a volume growth pick up to 8.7% this quarter versus 8.3% last quarter. The management of Dabur now joins us to give us more details of the quarter gone by. Mr. Sunil Duggal, who is the CEO of the company, is with us right now. Sunil, hi, afternoon. And as always, thank you for joining us. I was just going through your press release where you do mention that in a low growth and challenging environment, Dabur has continued to report a strong volume-led growth. Just give us an indication of what you expect to see in the next couple of quarters. Will it be very hard for you to sustain this 8.7% volume growth given that the macro conditions have slowed down?
Right. Well, if you just take the last quarter, the volume growths have been in the negative territory. It's hard to imagine, but they've been in the negative territory for key HPC categories like, say, oral care or hair oils. And the outlook for the future, at least for the near future, doesn't seem to indicate there'll be any significant uptick. So therefore, hanging on to these volume growths in HPC, in home and personal care categories in particular, is not going to be easy. And I think we'll have to exert whatever energy we have to get there. Growth in foods has been a little bit better. Category growths have been around 7%, but still nothing very encouraging. So far, the sharp increase in consumer confidence hasn't been translated into any great deal of traction on the ground. So growths are muted. The only positive sign is that the margin pressures would probably abate a little bit. We'll be seeing better gross margin delivery, which hopefully should flow down.
How is that
growths are a source of concern?
How is that, Sunil? Is it
Sorry, yes?
Are you seeing a softening of input prices, or how are you going to improve margins?
We would look at improving margins on the back of softening prices, input prices, and we do see a reduction in terms of the freight bill, for example, will come down quite dramatically. And the hydrocarbon down cycle should result in the downstream products becoming cheaper, but so far that hasn't happened, but it's a matter of time. So we would see some pressure abate as far as the gross margins are concerned. But the volume side, I think, presents a larger area of concern.
So when you say larger area of concern, what do you mean exactly? Because in the last couple of quarters, you have indicated that you will be able to sustain 8 to 10% volume growth and 12 to 15% revenue growth. Would you scale down that estimate now?
Not in a hurry, but I would be a little bit cautious in terms of giving those outlooks for the future now, because that was predicated on the back of an anticipation that there would be improvement in category growths, and we certainly won't see them trend down as they were in the last 2 or 3 quarters. But the downtrend continues as far as we got the September data, and it's as bad as what it was a month or 2 ago, and worse than what it was 3 to 6 months ago. So therefore, unless there is some improvement in this rate, improving volume growth is going to be very, very hard. We'll be lucky to hang on to the volume growth which we are generating so far. But having said that, I think consumer confidence being where it is, it should translate into better delivery on the ground as far as category movements are concerned. So I'm still optimistic, but so far the numbers don't seem to support it.
So any early leads from what happened in October sales, festive sales? Have they improved a bit? Or because I know these are not reflected in your the quarter number you're talking about, but any indication of what October is looking like?
I think the festive is not very material to us. The only thing which sells well during the festive season vis-a-vis the other parts of the year is the gift packs which we sell during Diwali, and sales of that have been again a little bit under what we anticipated. So it's not been a great Diwali season as far as our business is concerned. But having said that, Diwali is not very material as far as growths are concerned. I do expect growths to come back into our personal care and healthcare portfolios in this quarter, but we probably would see lower growth coming from foods on a very, very high base of last year and high growth in the previous quarters. So therefore, I think it will be a mixed bag. We should be able to see reasonable growths emerging, but the trend would be more towards personal care and healthcare, which we have invested a lot of money, and foods might trend down a little bit. But whatever the situation, it's going to be hard work to get to these 8 to 10% volume growths. And I think 10 to 12% at this point in time doesn't seem visible unless there is a dramatic shift in the way consumers are behaving on the ground.
Okay. So as far as your margins are concerned, going ahead, what should we expect to see by the end of this fiscal? And when will the price hikes that you've taken, when will that impact flow through?
Well, the flow-through is happening, and it will continue this quarter, and I don't think there will be any significant price increases now for the balance of the year. Whatever has been done will now kick in. Most of it has, some of it remains. So therefore, I think we should be able to see a margin improvement not less than 100 basis points emerging in the fourth quarter in particular, beginning in the third. We're still sitting on some high price inventories in beginning third quarter, but they should be exhausted by the middle of third quarter, and then we should see margin uptick appearing in our books. So the picture is a little bit more benign as far as the margin is concerned. And like I said, by the end of the year, 100 basis points, maybe 150 if you're lucky, is certainly what we would expect.
You did mention a while back that it is imperative for the industry to now take some steps to exert energy back into the sector. How would you be doing that? Will it be in the form of new product launches? Will it be in the form of higher ad spends that you would have to take?
One is continuing to invest in your brands. I don't think there's any point not spending enough in terms of communicating with the consumer. But I would be a little cautious in terms of introducing new products, especially at the discretionary end of the market. We are going to do some in the third quarter, but perhaps we won't do as many as we would have in a normal year. So it'll be a mixed bag of caution as well as aggression. Aggression on the A&P front, caution in terms of innovation. And then we'll calibrate the business every month and see how things are. And there is every possibility that the consumer sentiment may dramatically turn positive in a very short period of time. I mean, when I say sentiment, I mean actual purchase on the ground. The sentiment is already very positive. So it's hard to imagine a situation where consumer sentiments remain very positive for extended periods of time, but the demand doesn't translate into demand. So I think the situation will turn for the better very soon.
Okay. We actually have, we've started a new segment, Sunil, where we invite some of our viewers to pose questions to you, since they are investors in your stock as well. So we have a Mr. Nitin who writes to us from New Delhi. He asks, is the best for the international business yet to come? So basically he's asking you what the trajectory will look like for the international business.
Yeah, I think there are two parts to this. Is that our traditional business in the Middle Eastern and African regions has been doing extremely well. Okay. And if we continue that trajectory, that would be itself a great achievement. I think the acquired businesses need a better performance, particularly out of North America and parts of Africa. And we are engaged in a very committed fashion to turn around that business and get it into a high performance mode starting the fourth quarter. So I'm hopeful that the aggregate delivery of the international business would improve significantly on the back of improved performance by the acquired businesses in the next fiscal year.
Okay. Just a couple of more questions from my end. If you had to tell us where the slowdown is the fastest between skin, oral care and hair care, which is the one segment that you're most concerned about right now? Which one would it be?
Well, our exposure to skincare is comparatively low, even though skincare is perhaps the most damaged of all the categories in terms of growth. Hair oils is another area of concern where the category doesn't seem to be growing over the last many quarters. Oral care, while the category is not growing, we are pretty happy about our performance. We've been growing well ahead of category. Our higher margin products have been doing extremely well. So I'm very, very optimistic about our performance in the oral care space, particularly in toothpastes. But I think we will have to innovate very aggressively as far as hair oils is concerned, because there is change in user habits and behavior, and we have to measure up to that. So our HPC portfolio, which has been fairly muted in the first half of this year, I think should perform much better in the second half. And oral care perhaps will lead that performance.
So finally then, how long do you think it would take for not just Dabur, but for the entire industry to see that, 10-15% volume growth? Should we rule out FY15 completely?
I think going from -1 to +15 in a few months is hard to visualize. So I would rule out this year. I think if it can come back to the mid single digits, 5-6% volume growth, that would be a good way to end the year from where we are today. And then we should look at much more aggressive double-digit perhaps level growths in the next fiscal. But we've been through 7 months of this year, and the growths have been much below what we expected.
So what explains that this delay in translating, as you called it, consumer sentiment into actual demand?
I think one is that the price increases have been much higher than what normally is done by the sector. Typically 6, 7, 8% price increases. And perhaps there's been some pushback from the consumer as far as these are concerned. Also, I think there is a whole lot of low unit packs which are at very aggressive price points, offer great value to the consumer, but in a sense almost qualify as a down trading, which the consumer is perhaps now gravitating towards. They see great value in low unit packs, but from the company's perspective, it means less delivery in terms of tonnage, also less capturing of margins. So these would be the two reasons why the consumer is perhaps not reacting the way we expect them to.
All right, Sunil, we hope the consumer returns to the market very soon. All the best for the quarters to come, and congratulations on at least maintaining volumes and margins in a tough quarter like this. That's the word coming in from Dabur. Body language, as you have just seen, is not quite good. Consumer sentiment remains very weak, but within that entire environment, Dabur is doing well.
And as you pointed out, from a -1, he's come to 8.7, which is not too bad.
Yeah, not bad at all.